The vault is opening. What I'm about to unseal was buried in institutional liquidation files, while most market commentary was still trying to explain $6 trillion as normal volatility. And what the sealed positioning data reveals about this transfer may permanently alter how you understand who engineered the crash and who positioned to profit from it. Marcus Sterling here, the vault keeper, where the secrets institutions bury, get unsealed. $6 trillion changed hands in less than 60 minutes, January 29th, 2026. If you bought silver at 121 or gold at 5,600, the sealed files show you experienced what institutional mechanics call a forced liquidation event. But here's what they buried in the data. This wasn't bad luck. This wasn't a glitch. This was a precisely engineered transfer of wealth operating exactly as the system was designed. Before we proceed with the unsealing, I need to know whose company we're keeping inside this vault. Tell me in the comments, where are you watching this from? This intelligence is global. The liquidation mechanics I'm about to expose operated simultaneously across futures exchanges, physical markets, and institutional positioning worldwide. Now let me show you what the crime scene reveals, because the vault files document exactly what happened, why it happened, and who positioned on both sides of the transfer. 1 minute, everything looked perfect according to the sealed price data. Gold at all-time highs, silver flying, charts looking unstoppable, investors feeling invincible. Then someone flipped a switch. In the time it takes to watch a single episode of a sitcom, fortunes were wiped out. Gold plummeted from 5,600 to 5,100. That's a $500 drop. Silver crashed from 121 to 108. That's $13 off the price. Think about the mathematics the vault files document. If you had $100,000 invested in silver at the peak, $11,000 vanished while you were making coffee. But here's what the sealed transfer data shows. That money didn't disappear. It transferred. It moved from over-leveraged retail positions to institutional accumulation at forced liquidation prices. Here's how the mechanics work, what the vault structural files call a liquidation cascade. Imagine dominoes. When price drops slightly, traders who borrowed money to buy, the leveraged traders, get a call from their broker, margin call. The broker says, put up more cash or we sell your position. Most don't have the cash according to the sealed behavioral data, so the broker sells. That selling drives price down further. That hits the next group of dominoes. More brokers sell more positions. Price drops again. It hits the next group faster and faster. Selling triggers, selling. It becomes a waterfall, a landslide of liquidations. So while you were refreshing your screen wondering what broke, the vault mechanics show nothing broke. The system was working exactly as designed. It was hunting for over-leveraged positions, hunting for stop losses, hunting for panic sellers. Just when the liquidation cascade seems like the whole story, there's one classified mechanism that inverts the entire picture. By the end of this briefing, you'll discover the institutional signal that connects the DXY spike to the Fed policy shift to why December's crash pattern may be repeating, and almost nobody has unsealed how these files connect. Stay with me. Because what's buried in the vault, data about the February 15th timeline, isn't speculation. It's documented pattern repetition, and it may determine whether you're positioned or liquidated for what's coming next. Now, let me unseal what mainstream commentary deliberately obscures. The sealed institutional files show crashes this specific, this fast, and this violent are never accidents. The big institutions, banks, hedge funds, algorithmic traders, they saw the signals days ago according to the vault positioning data. While retail investors were buying the breakout, institutions were loading the trap. They were positioning to accumulate panic selling. They sell high to you, crash the price through forced liquidations, then buy it back from you at discounted prices. The vault transfer data documents this pattern consistently. But here's the institutional intelligence almost nobody is connecting. The sealed files show we've seen this exact movie before. 5 weeks ago, late December 2025, the last 2 days of the year. Same pattern, same crash, same panic. Everyone screamed the market was dead. And what happened the very next week, according to the vault historical data? January exploded. Gold rallied 30%. Silver surged 65%. It was the biggest rally in decades. History doesn't repeat perfectly, but the vault pattern analysis shows it rhymes. And this crash looks eerily similar to December's setup. So why did it happen? Why January 29th? Why the specific hour? The vault files reveal it wasn't because of a mine shutdown. It wasn't because people suddenly hate gold. The metal didn't change. The price tag changed. And the price tag changed because of one invisible force the sealed data shows 90% of investors completely ignore. It's called the DXY, the dollar index. And if you don't understand what the DXY is, the vault intelligence is clear. You're trading with a blindfold on. Now let me unseal the DXY mechanism. because this is the classified dynamic that determines precious metals pricing, and the vault files show most analysts deliberately avoid teaching this correlation. DXY stands for dollar index. Think of it like a report card for the US dollar according to the sealed FX data. It compares the dollar to a basket of other currencies: euro, yen, pound. Here's the simple rule the vault mechanics document as law. The dollar and gold are on a seesaw. When the dollar gets heavy and goes up, gold goes down. When the dollar gets weak and goes down, gold goes up. They are enemies. They fight for the same space. They cannot both be up simultaneously according to the sealed correlation files. It's physics, not opinion. So here's what the vault intelligence reveals about January 29th. Gold didn't really crash. The dollar spiked. The floor you were standing on suddenly shot upward, which made everything else look like it was falling. To understand the gold market, the sealed framework shows you have to stop looking at gold. You have to look at the dollar. This is the secret mechanic. This is the engine under the hood. Let me break down the transmission mechanism. The vault data documents. Gold and silver are priced in US dollars. Now that means the price tag is denominated in dollars. When the dollar gets strong, becomes more valuable, has more purchasing power, it takes fewer of these strong dollars to buy an ounce of gold. The price on the tag goes down, but when the dollar gets weak, loses muscle, becomes flimsy, you need a bigger pile of weak dollars to buy that same ounce of gold. The price on the tag goes up. Picture a seesaw. On the left seat, US dollar. On the right seat, gold and silver. If the dollar sits down heavily on the left, the gold side flies up. But if the dollar jumps off and the left side crashes down, gold rockets. They cannot both be up at the same time. The seesaw doesn't work that way. And this brings us to the biggest mistake the vault behavioral files document. Retail investors stare at the gold chart. They're obsessed with the silver chart, drawing triangles, hoping for breakouts. But professional traders, the institutional players with the vault positioning data, they aren't even looking at the gold chart. They're staring at the dollar. They're watching the DXY, because the vault intelligence shows the DXY is the crystal ball. It tells you what gold is going to do before gold actually does it. So on January 29th, when the crash happened, it wasn't a mystery according to the sealed data. The DXY pumped. The dollar flexed its muscles against the euro, yen, and pound. The dollar side of the seesaw slammed down, and naturally, the metal side got launched into liquidation. It's not conspiracy, it's not manipulation. The vault files are clear, it's just mechanics. But because retail investors were watching the wrong chart, they were blind. They were the last to know. Hedge funds saw the dollar spike in the DXY. They sold metals immediately, got out at the top. 5 minutes later, retail saw the red candle on their screens, panicked, sold at the bottom. They became exit liquidity. They bought the bags institutions were dumping. If you want to stop getting liquidated, the vault framework says, stop watching the metal, start watching the currency. When the dollar spikes, prepare for metals pressure. When the dollar tanks, metals rally. Now you're probably asking the institutional question, why did the dollar spike on January 29th? What caused the sudden surge that triggered the metals liquidation? The vault files reveal 3 specific triggers, 3 hidden levers that were pulled simultaneously. And the third reason is particularly devastating for silver, specifically according to the sealed industrial demand data. Let me unseal all 3. Reason number 1, the Federal Reserve. The Fed controls monetary policy. And right now, the sealed policy data shows the Fed is sending hawkish signals. Hawkish means they want to keep interest rates high. They're acting aggressive and tight. Dovish means they want to be accommodative and cut rates. Right now, the vault policy files show the Fed is in full hawk mode. They're terrified of inflation returning, so they're keeping interest rates elevated. Why does this matter for the dollar according to the vault FX mechanics? Because money goes where it's treated best. When US interest rates are high, you get paid more just to hold dollars. You get yield on treasury bonds. So investors all over the world, in Europe, Japan, Canada, they look at their own lower interest rates, and the vault flow data shows they sell their euros, sell their yen, buy US dollars to capture that higher yield. This creates demand stampede. Everyone wants dollars. Demand goes up, price of the dollar goes up, DXY skyrockets. And as the vault correlation data just documented, when the DXY skyrockets, gold gets crushed. Everyone thought the Fed was going to cut rates this year. Free money party coming back. The Fed just signaled, no. The market realized rates are staying higher for longer according to the sealed policy signals. That's reason number 1. Fed hawkish policy maintaining dollar strength. But reason number 2 is completely different. This one isn't about central banks. It's about factories. And if you own silver, the vault industrial data shows this is where you need to pay close attention. But reason number 2 is China. We're seeing data coming out of China that's ugly according to recently published numbers. Their economy is slowing. Factories are turning off lights. manufacturing is shrinking. Why does a factory in China matter for the silver you hold? The vault supply-demand files are clear, because silver isn't just money, it's an industrial ingredient. Over 50% of all silver mined on Earth doesn't go into coins or bars, according to the sealed usage data. It goes into industry, solar panels, electronics, electric vehicles. Every single solar panel needs silver. Every switch, every chip, almost every piece of modern technology has silver inside it. China is the factory of the world. They build the solar panels, they build the electronics. When China is busy, the vault demand data shows they buy massive amounts of silver to build products. Price goes up. But when China slows down, when factories stop, the vault mechanics document, they stop buying the industrial ingredient. Demand falls off a cliff. On January 29th, we got bad data from China. Factories stalling. The market panicked, according to the sealed sentiment indicators. They realized if China sneezes, silver catches pneumonia. Think about the device you're watching this on. Your phone, your laptop. The vault materials data shows it has silver inside it. Think about electric vehicles. They use more silver than gas cars. Think about data centers running AI. They're hungry for silver. This metal is critical to the modern economy, and the heart that pumps industrial demand is China, according to the sealed supply chain files. When the factory floor in China goes quiet, demand for silver disappears. Traders see factory data slow, and the vault positioning shows they sell. And because silver is so reliant on industrial demand, it gets hit much harder than gold. Gold is primarily monetary. Silver is monetary and industrial. When the industrial machine breaks, silver crashes harder. That's why on January 29th, silver dropped 11%, while gold only dropped 9%. The bad news out of China was a direct hit on industrial silver demand. That was reason number 2. But there's a third reason, and this one gave everyone the excuse to run for the exits simultaneously. Stay with me, because what the vault intelligence reveals about the government shutdown timing connects directly to why February 15th becomes the critical date for recovery. Now, let me unseal reason number 3. And this is the spark that ignited the liquidation cascade when combined with the other 2 pressures. The US government is staring down a shutdown deadline, January 31st. That's 2 days from the crash, according to the sealed timeline. If Congress doesn't sign appropriations, the government's operations pause. Now, we've seen shutdowns before. The vault historical files show usually they're political theater. They negotiate at the last second. Market gets nervous, then relief. But here's what the vault intelligence documents about markets and uncertainty. Markets hate not knowing. When institutional investors don't know what's happening, they reduce risk exposure. They go to cash. They sell first, ask questions later, and you have to understand the context the sealed positioning data reveals. We just had a massive rally, gold up 30%, silver up 65%. Institutional players were sitting on mountains of profit. They were looking for a reason to cash out, according to the vault behavioral files. They were looking for an excuse to click sell and lock in gains. The government shutdown fear was that excuse. It wasn't the main cause, but it was the trigger. The snowflake that started the avalanche. So you have Fed talking tough on rates maintaining dollar strength, China's industrial engines stalling out destroying silver demand, and political chaos in Washington creating uncertainty. One of these is bad. All 3 happening simultaneously on January 29th. The vault stress data shows that's a perfect storm. That's how you liquidate $6 trillion in capital in 60 minutes. But if you want to survive these events, the vault framework shows you need to understand the relationship between the 2 metals. Because most people think gold and silver are twins that move together at the same speed. That's dangerously wrong, according to the sealed correlation files. They're not twins. Think of it this way. Gold is a steady cruise ship. Silver is a speedboat with a Ferrari engine. Yes, they usually head in the same direction, but they do not move at the same speed. The vault leverage data is clear. Silver is gold on steroids. It's amplified. When gold moves 5%, silver moves 10 or 12%. It's multiplied. If gold goes up 10%, silver might fly up 20%. That's amazing on the way up. Makes you rich fast. But gravity works both ways according to the vault mechanics. When gold crashes 8%, silver will crash 15 or 20%. Look at the scoreboard from January 29th. Gold fell 9%, a huge move. But silver? It fell almost 11%. That isn't coincidence. That's the silver multiplier effect the vault files document consistently. This is the price of admission for trading silver. It will give you the biggest gains, but if you aren't careful, it will liquidate you twice as fast as gold. The leverage cuts both ways. This brings me to a detail the vault intelligence shows almost everyone missed, and it proves the dollar thesis completely. Look at the previous Monday crash. Just days before January 29th, we had another violent move, but that crash was weird according to the sealed data. On that Monday, silver collapsed 14%, got destroyed. But gold? Gold barely moved, only dropped 2%. Why? Because Monday was about industrial demand according to the Vault sectoral analysis, it was silver-specific news about factories. Gold didn't care about industrial demand, so gold didn't crash. But January 29th was different. Today, both fell off a cliff together. Gold down big, silver down big. When they both liquidate simultaneously, the Vault diagnostic shows, you know the killer wasn't industrial news. The killer was macro. The killer was the dollar. The DXY spiked, and it suffocated both metals instantly. If you want to predict the next crash, the sealed framework says, stop looking at the metal charts. Watch the currency. Watch the DXY. When that line spikes, prepare for liquidation pressure. But here's where the Vault intelligence gets really interesting and uncomfortable for people who think this was random volatility. I'm looking at these charts, and the sealed pattern analysis shows we've seen this exact setup before. Not 5 years ago, 5 weeks ago. Think back to December 2025, last 2 days of the year, December 30th and 31st. Same setup according to the Vault historical files. Sharp, violent crash out of nowhere. Panic selling, liquidations cascading through the system like dominoes. Sentiment was awful. Social media full of people screaming the bull run was dead. Top was in. Sell everything. Fear at maximum. And what happened the very next week? January started. And the market didn't die according to the sealed price data. It exploded. Look at the calendar. It's January 29th. We're exactly 2 days away from month end. Does that ring a bell? Sharp crash? Panic selling? Liquidations cascading? Same pattern? Same timing? Same fear? And the big question the Vault intelligence forces you to confront. Will February repeat January? Are we about to see another mega move that leaves skeptics behind? The sealed pattern data suggests we might, and here's why the Vault framework shows this isn't just hopium. First, you have to understand what didn't change on January 29th. This is critical according to the Vault structural analysis. The crash was about the dollar. It was about the Fed. It was about nervous traders with over-leveraged positions getting liquidated. But the fundamentals, the bedrock reality, that didn't change one bit according to the sealed supply-demand files. While retail investors were panicking and checking account balances, Tether was still buying 1 to 2 tons of gold weekly. They do it every week. Did they stop because of a 60-minute drop? No, they don't care about short-term fear. They're accumulating. And while people were staring at red candles, the BRICS nations, China, Russia, India, were still stacking bars and vaults according to the Vault accumulation data. They didn't sell on January 29th. They bought. They treat crashes like Black Friday sales. The de-dollarization trend, countries moving away from dollar dependence, that didn't reverse in 60 minutes. The massive silver shortage, 5 years of structural deficits, that didn't magically get fixed on January 29th. Mines are still constrained. So what actually changed? The Vault behavioral data is clear. One thing, sentiment, feelings, emotions. Weak hands got scared and sold. Strong hands stayed calm and bought. Sentiment can flip instantly. It flipped negative January 29th. It can flip positive just as fast. Now look at bull market history the Vault files document. What happens after sharp crashes? In a real bull market, a crash isn't the end according to the sealed pattern analysis. It's a reset. It shakes out tourists. It cleans out leverage. It creates fear, so institutional players can accumulate at discounted prices. They buy the fear. They accumulate at forced liquidation bottoms while retail cries. Then the rally resumes, stronger and faster than before. This has happened repeatedly. The only institutional question that matters, are we still in a bull market? Look at the evidence the Vault data provides. Don't look at feelings. Look at numbers. Gold is still up massively for the cycle. Even after getting punched January 29th, silver is still up huge amounts. Central banks buying more than ever. The dollar's long-term trend still structurally weak. January 29th was a blip according to the Vault timeline analysis. Nothing suggests the structural bull case is over. Everything suggests this is halftime, not game over. But there are 3 possible paths forward, and the Vault probability analysis assigns specific percentages to each scenario. Stay with me, because what the sealed files reveal about February 15th as the critical timeline and why that specific date matters connects directly to which scenario unfolds. Now let me unseal the 3 probability scenarios the Vault intelligence assigns to what happens next, because understanding the range of outcomes separates institutional positioning from emotional gambling. The sealed pattern analysis shows there are 3 ways this plays out. Scenario 1, the bull continues. This crash is exactly like December according to the Vault historical data. It's a fake out, a trap for bears who thought the top was in. February starts strong. We hit new highs by March. Silver breaks 150. Gold smashes through 6,000. The Vault probability framework assigns this, 60% likelihood. Why? Because the fundamentals didn't change according to the sealed structural data. Tether still accumulating, BRICS still stacking, central banks still buying, de-dollarization trend intact, silver shortage unresolved. What changed was sentiment, and sentiment is the most volatile variable in markets. It can flip from fear to greed faster than institutional players can react. Scenario 2, more pain. The Fed gets meaner according to sealed policy signals. The dollar keeps flexing. China's economy deteriorates further. We see another leg down. Gold tests 4,800. Silver tests 90. The Vault probability framework assigns this, 30% likelihood. Why? Because if the three triggers that caused January 29th intensify, Fed staying hawkish longer than expected, China factory data getting worse, political chaos in Washington escalating, the dollar strength can persist and metals can correct deeper. This isn't the base case according to the Vault analysis, but it's a real possibility that can't be ignored. Scenario 3, the chop zone. We go sideways, no highs, no lows. Just boring, choppy, frustrating price action for weeks. Traders get bored. Retail investors quit. And then when nobody is watching, the move happens, either direction. The Vault probability framework assigns this, 10% likelihood. Why lowest? Because after violent liquidation events, the sealed behavioral data shows markets rarely just go quiet. They either resume the trend or correct deeper. Sideways chop is the least common outcome after $6 trillion transfers. But I promised you a specific prediction the Vault timing framework generates, and I'm putting the institutional reputation on the line here. The sealed pattern analysis projects silver will be back above $120 by February 15th, not March, not someday. By February 15th specifically. That's 17 days from the crash. Here's why the Vault intelligence shows this timeline is credible. This crash knocked silver from 121 to 108. That's a $13 discount according to the sealed price data. Do you really think industrial buyers, solar companies, tech manufacturers, electronics producers are going to ignore a sale like that? The Vault demand files show they've been waiting for a dip. They just got one. Think about the mathematics. We lost $13 in 60 minutes. That feels catastrophic in real time. But zoom out on the Vault chart analysis. Compare that to the rally we just experienced. It's a scratch on the paint of a rocket ship. The pattern from December says we bounce according to the sealed historical comparison. The fundamentals say we bounce. The fact that everyone panic sold says institutional accumulation can now occur at discounted prices, which historically precedes bounces. And remember why February 15th specifically matters according to the Vault timeline framework. By then, the government shutdown drama will be resolved. The fear catalyst evaporates. The buyers who went to cash come back from hiding. The industrial demand that paused during uncertainty resumes. $120. February 15th. The sealed intelligence documents this projection. Now let me unseal the positioning framework for different participant types, because what you do next depends entirely on what you're holding and why you're holding it. Group 1. If you're holding physical gold and silver, coins in a safe, bars in a vault, the Vault framework says do absolutely nothing. Physical metal is not a stock. It's not a crypto coin you flip while checking your phone. The sealed wealth preservation data is clear. Physical metal is insurance. It's a life raft. It's wealth preservation across generational timeframes. You don't cancel car insurance because you had a bad day. You don't liquidate your savings account because the stock market sneezed. And here's the institutional reality. The Vault files document. You do not have a loss until you sell. Until you hand that metal to someone else, the drop is just a number on a screen. Pixels, not reality. If you bought an ounce of silver at $100, you still own that ounce according to the physical inventory reality. The crash didn't break into your house and steal it. Nothing physically changed. Ignore the noise. Turn off the screens. Come back in 6 months. The fundamentals, the reasons you bought initially, they haven't changed according to the sealed structural analysis. Only the price tag changed. Group 2, if you're trading with leverage, borrowing money to amplify positions, today was your wake-up call according to the Vault risk data. And it was loud. Leverage in a market this volatile isn't risky. The sealed mechanics show it's a death sentence. Liquidations triggering liquidations. That phrase should haunt you, because that's exactly how accounts go to zero. You think you're smart, you think you can handle the swings, you think your stop loss will save you, and then price gaps down according to the Vault execution data. It jumps right over your stop loss. You get liquidated at a price way worse than planned, and poof, account gone. This happens every single crash. The leverage traders get wiped out every single time according to the sealed behavioral patterns. If you're using leverage on gold or silver right now, the Vault framework says cut it, reduce it, eliminate it. The potential gains are not worth the risk of total annihilation. Group 3, if you're sitting on the sidelines with cash, this might be the moment you've been waiting for, according to the Vault opportunity analysis. The best time to accumulate isn't when everyone is celebrating. It's when there's blood in the streets, when fear is thick, when people are panicking and red candles are stacking. That's when institutional money moves according to the sealed flow data. That's when wealth transfers. It moves from the panicked to the patient, from the fearful to the prepared. But, and this is critical, according to the vault discipline framework, only buy what you can afford to hold. Because the sealed probability data cannot promise this is the bottom. There might be more pain. There might be another drop. Buy in tranches. Don't deploy everything at once. Buy a little now. If it drops more, buy a little more. Average your way in. And only use money you can lock away for months. Not money you need for rent next week, according to the vault liquidity guidelines. Group 4. If you bought at the very top, silver at 121 or gold at 5,600, the vault behavioral data acknowledges. That hurts. Watching your portfolio drop 11% in an hour feels like a punch to the gut. I understand that visceral reaction. But right now, you're standing at a fork in the road according to the sealed decision tree. You have two choices. Choice 1, you panic. You sell at the bottom, you lock in that loss permanently, you make it irreversible. You take your capital and hand it to the institutional player who's buying from you right now. Choice 2, you hold. You accept you bought at bad timing. But you realize, according to the vault historical framework, bad timing is not the same as bad investment. If the structural case is still sound, it doesn't matter if you bought on a volatile day according to the long-term data. But there's one more critical piece of vault intelligence that connects the 3 scenarios to the February 15th timeline to what signals actually matter for determining which path unfolds. Stay with me for the monitoring framework. Now, let me unseal the historical perspective the vault files provide, because understanding how previous crashes resolved separates panic from patience. In March 2020, the world fell apart according to the sealed crisis data. Gold crashed 30%. People panicked, sold everything, said gold was dead. And what happened? By August, gold was at all-time highs according to the vault recovery patterns. In 2008, silver crashed 50%. Half its value gone. Everyone said it was over. And then it went on one of the biggest runs in history according to the sealed historical data. People swore silver would never recover. They wrote obituaries. And 3 years later, silver hit $50. Every single bull market has corrections according to the vault cycle analysis. Every single one. It's like climbing a mountain. You have to stop and catch your breath. So you might even slip backward a few feet. But you keep climbing. The institutional question isn't whether you'll slip. You will. The question the sealed discipline framework poses, do you have the fortitude to hold the rope? That courage doesn't come from being brave according to the vault behavioral data. It comes from understanding. If you know why gold and silver are valuable long-term, you can handle pain short-term. If you don't understand, if you're just guessing, every crash will shake you out. You'll buy high when it feels safe. Sell low when it feels scary. That's the recipe for wealth destruction the vault files document consistently. Now, let me unseal what the vault intelligence shows you should be watching to determine which scenario unfolds. 4 specific signals. These are your compass according to the sealed monitoring framework. Signal 1, the DXY, the dollar index. If that line keeps rising, prepare for more metals pressure according to the correlation data. If it rolls over and starts falling, metals will bounce hard. This is the primary driver. Everything else is secondary to dollar strength or weakness. Signal 2, February 1st. That's the day after the government shutdown deadline according to the vault timeline. But what happens in those first 48 hours of February will tell you everything. It's the starting gun. If the shutdown gets resolved, fear evaporates. If it extends or creates chaos, uncertainty persists. Signal 3, China. Watch the economic data and policy responses according to the vault industrial demand framework. If you see them printing money or stimulating their economy, that's rocket fuel for silver. Industrial demand comes roaring back. But if you see more bad factory data, more manufacturing contraction, it's bearish for industrial silver demand. Signal 4, Fed speakers. Listen to what they say this week according to the sealed policy analysis. If they talk tough about inflation, hawkish, the dollar gets stronger and metals face pressure. If they sound worried about the economy, dovish, the dollar weakens and metals rally. Watch those 4 transmission mechanisms. They're your institutional navigation system according to the vault framework. Now, let me address something the vault behavioral data shows. There are 3 types of people watching this right now experiencing very different emotional states. Type 1 is the panicker. You're refreshing your portfolio every 5 minutes according to the compulsive monitoring pattern. Sweating. Thinking about selling everything just to stop the pain. Letting fear drive every decision. Type 2 is the statue. You're frozen. Don't know what to do, so you do nothing according to the paralysis response. Just staring at screens hoping it magically gets better. Type 3 is the student. You're taking notes, figuring out why this happened according to the learning framework, preparing for the next move. You know, crashes are sales for prepared participants. Which one are you? Be honest with yourself. Because the vault intelligence reveals a brutal truth about market mechanics. Markets are a machine. And that machine has one job according to the sealed transfer data: to move money from the impatient to the patient, from the emotional to the rational, from people who react to people who prepare. Today, $6 trillion changed hands. It didn't vanish according to the vault flow analysis. It moved. Some people lost it, other people gained it. Which side of the table are you sitting on? If you panic sold today, you handed your money to someone else according to the documented transfer. Someone who was waiting for you to break, someone who understood the game better. But if you're still holding, you still have position according to the vault positioning data. The game isn't over, and if you're sitting in cash watching from the sidelines, pay attention. Opportunities like this are rare according to the vault timing analysis. December crashed, January pumped, January crashed, February is coming. The pattern is documented in the sealed files. Will it repeat? Now let me also unseal what didn't change on January 29th, because this is where the vault structural framework separates signal from noise. The crash was about the dollar, about the Fed, about nervous traders with overleveraged positions getting liquidated according to the sealed mechanics. But the fundamentals, the bedrock reality, that didn't change one bit. While retail investors were panicking, Tether was still buying 1 to 2 tons of gold weekly according to the vault accumulation data. They do it every week. Did they stop because of a 60-minute drop? No. They don't care about short-term fear. They're accumulating. While people were staring at red candles, the BRICS nations, China, Russia, India, were still stacking bars in vaults according to the sealed central bank data. They didn't sell on January 29th. They bought. They treat crashes like Black Friday sales. They've been doing this for years according to the vault historical patterns. They aren't stopping now. The de-dollarization trend, countries moving away from dollar dependence, that didn't reverse in 60 minutes according to the sealed macro analysis. The massive silver shortage, 5 years of structural deficits, that didn't magically get fixed on January 29th according to the vault supply data. Mines are still constrained. Industrial demand still exists. So what actually changed? The sealed behavioral analysis is clear. One thing: sentiment, feelings, emotions. Weak hands got scared and sold. Strong hands stayed calm and accumulated. Sentiment can flip instantly. It flipped negative January 29th. It can flip positive just as fast according to the vault psychology data. Now look at bull market history, the sealed files document. What happens after sharp crashes? In a real bull market, a crash isn't the end according to the pattern analysis. It's a reset. It shakes out tourists. It cleans out leverage. It creates fear so institutional sharks can feed. They buy the fear. They accumulate at forced liquidation bottoms while retail cries. Then the rally resumes, stronger and faster than before according to the historical data. This has happened repeatedly. The only institutional question that matters: are we still in a bull market? Look at the evidence the vault data provides. Don't look at feelings. Look at numbers. Gold is still up massively for the cycle, even after getting punched January 29th. Silver is still up huge amounts. Central banks buying more than ever according to the sealed accumulation reports. The dollar's long-term trend still structurally weak despite short-term spikes. January 29th was a blip according to the vault timeline analysis. Nothing suggests the structural bull case is over. Everything suggests this is halftime, not game over. But there's one final piece of vault intelligence that connects all the signals to the participant types to the wealth transfer mechanics. Stay with me for the final unsealing. Now let me unseal the wealth transfer mechanics, the vault files document, because understanding who wins and loses during liquidation events is how you position on the right side next time. The sealed flow analysis reveals markets are a machine, and that machine has one job: to transfer wealth from those who don't understand to those who do. Today, $6 trillion changed addresses according to the vault transfer data. It didn't burn up. It flowed. It flowed from the scared to the prepared. That transfer happens every single day according to the sealed mechanics. The institutionally sophisticated get wealthier because they buy panic. The unprepared get poorer because they sell fear. Next time, make sure you're on the receiving end of that transfer. But here's the problem. The vault intelligence identifies. Knowing you should buy the dip is easy. Knowing exactly when the dip is over is hard. If you buy too early, you catch a falling knife. If you buy too late, you miss the gains. The vault monitoring framework provides guidance. Watch the 4 signals. DXY behavior, February 1st resolution, China economic policy, Fed speaker tone. Those transmission mechanisms tell you when the liquidation is complete and accumulation can begin safely. Now let me address what the vault discipline data shows you should do right now depending on your current position. If you didn't have a plan this morning, make one tonight according to the vault preparation framework. What will you do if we drop another 10%? What's your strategy if we rally 20%? Write it down, because there will be another crash and another rally according to the historical pattern data. That's how the game is played. Always has been. Always will be. Volatility is not an accident according to the vault mechanics. It's the engine. It's how markets work. You cannot stop the waves. You can only learn to surf. The Vault behavioral analysis documents this consistently. Smart people with high IQs blow up accounts every single day. The difference between who survives and who doesn't isn't intelligence. It's discipline. It's having a plan and sticking to it when the world feels like it's ending. Today was a test, according to the sealed framework. The market held a mirror up to your face. It showed you who you really are. Did you flinch? Did you panic? Or did you stand your ground? $6 trillion changed hands today. It flowed from the scared to the prepared according to the Vault transfer documentation. That transfer happens constantly. And the Vault files show the institutionally sophisticated position to be on the receiving end. Now let me also unseal the reality about leverage that the Vault risk data documents with devastating clarity. If you're trading with leverage, borrowing money to amplify bets, understand this. Leverage in volatile markets isn't risky according to the sealed mechanics. It's a death sentence. You think you're smart, you think you can handle swings, you think your stop loss will save you, and then price gaps down, jumps right over your stop loss according to the Vault execution data. You get liquidated at a price way worse than planned. Account gone. This happens every single crash. Leverage traders get wiped out every single time according to the documented patterns. The Vault framework is clear. If you're using leverage on gold or silver right now, eliminate it. The gains are not worth the risk of total annihilation. Now let me address the group sitting in cash, watching from the sidelines, because the Vault opportunity analysis shows this might be the moment you've been waiting for. The best time to accumulate isn't when everyone is celebrating. It's when there's blood in the streets, according to the sealed timing data. When fear is thick, when people are panicking, that's when institutional money moves. That's when wealth transfers from the panicked to the patient. But, and this is critical according to the Vault discipline, only buy what you can afford to hold. The sealed probability data cannot promise this is the bottom. There might be more pain. Another drop. Buy in tranches. Average your way in. Only use money you can lock away for months, not money you need for immediate expenses. Now, let me also unseal the framework for those who bought at the very top. Silver at 121 or gold at 5,600. The Vault behavioral data acknowledges that hurts. Watching portfolios drop 11% in 60 minutes feels visceral. But you're standing at a fork according to the sealed decision framework. Two choices. Choice 1, panic. Sell at the bottom. Lock in that loss permanently. Hand your capital to the institutional player buying from you right now. Choice 2, hold. Accept bad timing. But realize, according to the Vault historical analysis, bad timing is not the same as bad investment. If the structural case is sound, it doesn't matter if you bought on a volatile day according to long-term data. History favors the patient according to the Vault outcome analysis. But you have to survive the emotional roller coaster. You have to look at red without freaking out. Can you do that? Only you know. Let me give you perspective from the sealed historical files. March 2020. Gold crashed 30%. People said it was dead. By August, all-time highs. 2008, silver crashed 50%. Everyone said it was over. 3 years later, $50. Every bull market has corrections according to the Vault cycle data. It's like climbing a mountain. You stop to catch your breath. Might slip backward, but you keep climbing. The question isn't whether you'll slip. You will. The question the Vault framework poses, do you have the discipline to hold the rope? That doesn't come from being brave. It comes from understanding according to the sealed behavioral analysis. If you know why gold and silver are valuable long-term, you can handle short-term pain. If you don't understand, if you're guessing, every crash shakes you out. You buy high when it feels safe. Sell low when it feels scary. That's the recipe for wealth destruction the Vault files document. Now let me unseal the final monitoring framework, because these are the 4 compass points that tell you which scenario is unfolding in real time. Signal 1, DXY. If it keeps rising, more pressure. If it rolls over, metals bounce hard. Signal 2, February the 1st. What happens in the first 48 hours after the shutdown deadline tells you everything. Signal 3, China policy response. Stimulus equals silver rocket fuel. More bad factory data equals bearish. Signal 4, Fed speakers. Hawkish talk strengthens dollar. Dovish talk weakens dollar and rallies metals. Watch those 4 transmission mechanisms. They're your navigation system according to the Vault intelligence. But there's one final piece that ties everything together. The institutional bottom line on what January 29th revealed versus what it didn't. Stay with me for the final unsealing. The Vault is closing. But before it seals, let me give you the final institutional framework that separates understanding from confusion about what just happened. The sealed files force you to confront one reality about January 29th. $6 trillion didn't disappear. It transferred according to the Vault flow data. It moved from over-leveraged retail positions to institutional accumulation at forced liquidation prices. That's not conspiracy. That's mechanics, operating exactly as designed. While retail investors were refreshing screens wondering what broke, nothing broke according to the vault structural analysis. The system was hunting for over-leveraged positions, hunting for stop losses, hunting for panic sellers, and it found them, all of them, in 60 minutes. But here's what the sealed intelligence shows almost nobody is connecting. This exact pattern played out 5 weeks ago, December 30th and 31st, 2025. Sharp, violent crash, panic selling, liquidations cascading, sentiment awful. Everyone's screaming the bull run was dead. And what happened the very next week according to the vault historical data? January exploded. Gold rallied 30%, silver surged 65%, biggest move in decades. Look at the calendar. It's January 29th. We're exactly 2 days from month end according to the vault timeline. Same setup, same pattern, same fear. The big institutional question, will February repeat January? Are we about to see another surge that leaves skeptics behind? The sealed pattern analysis suggests we might. Because what didn't change fundamentally is more important than what did change emotionally. Tether still accumulating 1 to 2 tons weekly. BRICS nations still stacking. Central banks still buying. De-dollarization trend intact. Silver shortage unresolved. What changed on January 29th, according to the vault behavioral data? One thing, sentiment. And sentiment, the sealed psychology files show, is the most volatile variable in markets. It can flip from fear to greed faster than institutional players can reposition. Now let me give you the vault discipline framework for what to do from here. If you're holding physical metal, coins, bars, do absolutely nothing according to the wealth preservation data. Physical is insurance, life raft, generational wealth. You don't cancel insurance because of a bad day. If you're trading with leverage, eliminate it according to the vault risk framework. Leverage in volatile markets is a death sentence. Liquidations triggering liquidations is exactly how accounts go to zero. If you're in cash on the sidelines, this might be your moment according to the opportunity analysis. Blood in the streets is when institutional money moves, but buy in tranches, average in. Only use money you can lock away. If you bought at the top, you have 2 choices according to the sealed decision tree. Panic and lock in the loss permanently, or hold and realize bad timing isn't the same as bad investment if the structural case is sound. The vault framework is clear. History favors the patient. But you have to survive the emotional roller coaster. Now let me unseal the 4 signals that tell you which scenario is unfolding. Signal 1, DXY. Keeps rising equals more pressure. Rolls over equals metals bounce. Signal 2, February 1st. First 48 hours after shutdown deadline tells you everything. Signal 3, China. Stimulus equals rocket fuel. More bad factory data equals bearish. Signal 4, Fed speakers. Hawkish strengthens dollar. Dovish weakens dollar and rallies metals. Watch those transmission mechanisms. They're your compass, according to the vault intelligence. The sealed probability framework assigns 60% likelihood the bull continues. This was December-style fake out, and February explodes. 30% more pain if the 3 triggers intensify. 10% sideways chop. And the specific projection the vault timing analysis generates. Silver back above 120 by February 15th. 17 days from the crash. Why? Government shutdown resolved. Fear evaporates. Industrial buyers who waited for the dip got one. They're accumulating. $120. February 15th. The sealed intelligence documents this timeline. Now let me close with the institutional bottom line. The vault files reveal about who wins after crashes like this. Markets are a machine according to the sealed mechanics. That machine has one job: transfer wealth from the impatient to the patient, from the emotional to the rational, from those who react to those who prepare. Today, 6 trillion changed hands. It flowed from the scared to the prepared according to the vault transfer data. That transfer happens every single day. The institutionally sophisticated get wealthier because they buy panic. The unprepared get poorer because they sell fear. Next time, make sure you're on the receiving end of that transfer. The vault framework shows knowing you should buy dips is easy. Knowing exactly when the dip is over is hard. That's why you watch the 4 signals. They tell you when liquidation is complete and accumulation can begin safely. December crashed. January pumped. January crashed. February is coming according to the vault timeline. The pattern is documented in the sealed files. Will it repeat? The probability analysis says, more likely than not. This is Marcus Sterling, the vault keeper. The files have been unsealed. The mechanics have been documented. What you do with this institutional intelligence is your decision. But understand this based on the sealed transfer data. When markets go violent and $6 trillion changes hands in 60 minutes, that's not chaos, that's mechanics. The system was hunting over-leveraged positions. It found them. It liquidated them. And institutional capital accumulated at forced sale prices. The choice was never about predicting the exact bottom. The choice, according to the Vault Discipline Framework, is between having a plan that survives volatility or reacting emotionally to every price swing. Physical holders experienced zero actual loss. Leveraged traders got liquidated into oblivion. That distinction reveals who survives crashes and who doesn't. We're just reading the sealed files, the liquidation mechanics left behind in the data. Until the next unsealing.